Banks use your credit score as a literal pricing tier to determine exactly how much they'll charge you for debt. This table compares two identical $30,000 auto loans. The left borrower gets a 6% interest rate, while the right gets 20% based on their credit score. Over the loan's life, that higher rate costs an extra $25,000 penalty to your wallet. Most people assume fixing a damaged score requires years of passive waiting and perfect financial behavior. The 2026 scoring models actually function as highly predictable mathematical algorithms. If you want fast results, you have to aggressively manipulate the specific variables the algorithm weights the heaviest. Credit repair is an exercise in resource allocation. Once you know the rules, you can focus your cash and effort where they produce the most immediate impact. This pie chart shows the math behind your score. Payment history is 35%, credit utilization 30%, length 15%, and credit mix plus inquiries make up the final 20%. Combined, payment history and utilization control 65% of your outcome. Focus here for the fastest results. To attack that 65% block efficiently, we can map our options on this quadrant chart, measuring the impact on your score against the effort or cash required to execute each fix. Your highest return action is Fix 1, deploying cash to aggressively pay down credit card balances below 30% of your limit, and ideally below 10%. The critical overlooked variable is timing. Pay before the statement closing date, not the due date. This plots high on the impact axis. Utilization models update instantly. Paying a balance down to 10% today raises your score within one billing cycle. The trade-off is liquidity. Using your cash reserves to pay down debt reduces the amount of money you have available for immediate emergencies. To secure the payment history factor, use Fix 2. Automate minimum payments and send goodwill letters for past slips. This data point plots high impact, low effort. Automation removes error, preventing a 30-day late mark that could drag your score down for 7 years. The risk here is checking account management. Automated payments require you to ensure your balance covers the withdrawal to avoid bank overdraft fees. Addressing these two factors immediately captures the majority of available points, providing the highest possible mathematical return on your time. Next, we address the 15% factor, length of credit history. A common mistake is closing old credit cards that you no longer use. Fix 3 is a defensive strategy. Keep those older cards active by assigning a single, small recurring subscription to them and setting that to autopay. Keeping those accounts open allows your average account age to remain stable. It also pads your total available credit, which helps keep your overall utilization ratio low. This requires a small administrative trade-off, as you'll need to monitor these dormant accounts for fraudulent charges or new annual fees. Preserving your account history protects your overall credit capacity from shrinking over time. If you lack the cash to pay down balances or a clean history to leverage, you have to use external pressure. Fix 4 is the authorized user injection. This involves being added to a trusted family member's long-standing, low-utilization credit card account. This chart's extremely high on impact and very low on effort. It allows you to inherit years of positive payment history and a boost in available credit without even needing to use the physical card. The trade-off is social risk. If the primary account holder misses a payment or maxes out that card, your score will drop alongside theirs. This mechanism creates a rapid, structural transfer of positive credit data from one person's established file directly over to another. Beyond your own spending habits, roughly 20% of credit reports contain an error that drags down a score. Fix 5 involves pulling your free annual reports from all 3 bureaus and filing formal disputes for any inaccuracies you find. This is high impact, but also high effort. When you dispute an error, bureaus have 30 to 45 days to verify the mark. If they can't, they must remove it, often resulting in a sudden score jump. The bureaucratic friction is significant. You'll need to organize documentation and potentially follow up multiple times if the initial dispute is rejected. Borrowing credibility or weaponizing the dispute process are the most effective paths when you don't have immediate liquidity. The core mathematical truth is that you should ignore credit mix or new inquiries until the core 65% of your score is fully optimized. This decision tree maps the correct algorithmic fix to your current financial reality, whether you are cash rich, cash poor, or just establishing a baseline. Those with liquid cash should follow the cash-rich path to Fix 1. Optimizing your utilization before the statement close date is your most powerful lever. If cash is tight, the cash-poor path relies on Fixes 4 and 5, using social capital and bureaucratic pressure to rebuild. Everyone should implement the baseline path. Fixes 2 and 3 provide the foundational automation that protects your score over the long term. A high credit score is the mathematical reward for understanding and playing the algorithm's specific game. Check your credit utilization right now. Are you above or below 30%? Drop your number in the comments and subscribe for more objective 2026 optimized financial analysis.